Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is David Chan. David has over 7 years experience in finance and technology across agribusiness. He holds an MBA from Harvard Business School and a BS in atmospheric science from Cornell University College of Agriculture and Life Science. Prior to joining FarmTogether, David was a senior private equity associate with Amera Capital Management, an asset manager that specializes in ag investments. He previously worked at Prudential Agricultural Investments, Grow Intelligence, and Barclay Investment Bank. David is also a member of Lead New York's Class 19, a leadership program managed by Cornell for committed leaders in the agricultural and food sector. David, welcome to the show.
Thank you, Keith. Great to be here.
Yeah, I'm excited to unpack your story. As I mentioned before the show, you're our first person that specializes in the agricultural investments, and I'm just excited to hear about it. I've been seeing a lot of offerings and different things out there with respect to them, but I'm with all your experience, very excited to hear about what you have going on. But if we could, I always start, David, with just kind of your background, where you grew up and what led you to the agricultural business and then eventually the real estate investing business?
Yeah, absolutely. So this is super cliche, but it's true. My path is definitely not linear, and I could never have projected being in this world, even though I grew up around it. So that's the irony of life, I guess. But I grew up in the Hudson Valley in upstate New York. We were previously America's apple capital. Now we've been surpassed there by Washington State and high density apple orchards, but that's okay. We love Washington. And so I grew up around commercial ag. As a child, my first job was being a picker at one of the nearby orchards. And so it was just a normal part of life around my community. And my lifelong passion, even to this day, though, has always been climate and weather. So growing up in the Hudson Valley, I got to see tornadoes, hurricanes, blizzards, thunder, snow, my personal favorite, just about every single form of weather that you could imagine. And, I would spend all my time watching the Weather Channel, and I was just a huge nerd. And so I studied atmospheric science in college and had every intention of, either pursuing a PhD or being in the meteorology field in a very academic way. But during my studies, I started to realize that one, climate change is a real challenge that we are already facing, but we're going to continue to face. And so I thought that was a sort of a problem of a lifetime to try to solve, and
Right.
a very interesting one. And I thought, from a research angle, we knew enough to know that we need to do something about this problem. And so I started to see less value of, at least for me personally, of doing more research and more value in trying to be part of a change somehow in industry. Whether that meant business or law or policy, I had no clue. I just knew that I wanted to be in a field that I thought could be part of the solution on how we will adapt and hopefully mitigate future climate change. And that's how I landed in ag. Never thought I would be back in this industry, but I think the natural place for professionals like me who want to be involved in a climate focused industry would be energy, renewables, wind, solar, proven technologies that are heavily invested in today, and I would say sort of mainstream, at
Yeah.
least for this angle. And I thought ag was so much more interesting because ag has so much less investment and less attention as an asset class, but is so critically important to so many different facets of society and our everyday being. But beyond that, land's ability to serve as a carbon sink is tremendous. And I think, it certainly has received more attention as of late, but even just 10 years ago, no one was really talking about this too much. And certainly no one was really investing around it or didn't feel that way. So I thought, run towards the place where no one else is really looking. And that's going to be a really fun career. And so that's how I landed in ag. And, every step of the way since I've been looking really to place myself at this point where agriculture and finance come together, because I do think we need to see more investment dollars come into this vitally important asset class. If you look back at just history of different societies, empires, almost every single war comes down to availability of food.
Yeah.
And agriculture is such a paramount, it is the pillar of everything. When we think about security and societal progress and all those really important factors. So it's every single country, every single community thinks about this. Some I would say, more passively than others. And that's a good thing if you don't think about it often. Most Americans don't really think about agriculture until a pandemic strikes and they go into their local Whole Foods and they don't see a shelf of beautiful tomatoes available, which they've been accustomed to seeing for the past 15 years. And then they think, oh, what's wrong? Why aren't the tomatoes here? Why aren't the beautiful apples here? And I think that was maybe the first time, at least for most Americans, to really take account of how precious our food supply is and how important this asset class is. And so for me, it's really twofold there. It's a tremendously vital asset class that I think needs more capital. And two, I think it independently holds so much promise as an asset class that can be part of the solution for how our climate's changing.
Okay. Yeah, there's a lot there. And so, where did you go after graduating, and how did, what job was your first one within this industry, and has that changed as you've moved to different companies?
My first job was certainly not, hitting on all these points that I was super interested in. It was really more around building a really sound technical background in finance. And so I started at Barclays Investment Bank, large investment bank in New York City, and I was working on European equities. So it was not agriculture related. I was working on some of the largest European corporate equities around their dividends. Telecom companies and natural resource companies and a really broad group of public equities in Europe. But I was able to develop a very transferable skill set there in financial analysis and modeling, and use that to not only help me in my next role, but really help me throughout my career so far. So from Barclays, I helped start a company called Grow Intelligence. That company focuses on ag analytics and climate AI, climate modeling. And so when I joined, I originally started on the research team and then started our business development team and really helped to create some of the early go-to-market strategy and commercialization of our product. That was a software as a service or a SaaS company. So we sold analytics and Grow Intelligence still sells analytics to decision makers, policymakers, anyone who's involved, both in agriculture, agribusiness, or broader, in the climate field. And then from there, I went to business school and started to pivot a little bit more closer towards combining these two experiences, one on finance, one in closer to ag, combining those two experiences into ag investing and taking roles at companies like Prudential and Amera, where I was able to do both.
Okay. And with the analytics that you were talking about, who is interested in the analytics, and what kind of analytics were you measuring?
A lot of different types of, I would say, potential users, and we were looking at variables that I still use today, and our team at FarmTogether still uses today. So information, like I would say, a lot of different weather data, average rainfall, average temperatures, chilling and cooling degree day, or cooling and heating degree days, chilling hours, just a lot of environmental variables that you would look at if you're underwriting a real property in agriculture. But then other factors as well, like NDVI, which is a normalized difference in vegetation index, basically satellite data that shows you how healthy particular vegetation may be based on the level of greenness that the satellite is able to capture from its imagery. We would look at macroeconomic data. So retail prices of agricultural goods versus wholesale prices versus farm gate prices. So seeing how value across the value chain is shared and created, and and how it flows from very high up on the value chain at the farm gate level all the way down to consumer. Other macroeconomic data like GDP, leverage, GNP. So really a pretty broad set of variables, some being environmental, some being macro, some being even microeconomic. But we were, at least at Grow, and even a lot of the work that we're doing at FarmTogether, we were essentially building tools to enable us to make better decisions as key decision makers in agriculture. And so if you think about who else could have been a user of that information, or who else would care about some of this information, obviously farmland investors would be among them, but
Right.
farmers, farm managers, policymakers, whether you work for a local government, state, federal, or country, if you work for a coalition, say like the United Nations, obviously they're heavily involved in different food policies and where to direct aid and food subsidies. So those would be decision makers who could care about that. CPG companies who may be big buyers of agricultural commodities for their goods, for forecasting purposes, management consultants and consulting firms who may be advising CPG companies or multinational corporates on decisions. So a lot of different types of potential users.
Yeah. That's interesting. And just, you mentioning the word underwriting, but basically as you're working with companies, if they're considering a specific property, you're looking at, can it support, and I would imagine the various crops, have different requirements. And so kind of passing them through these analytics that you have will, say, is that a viable option for us to grow this, and can we get the biggest yield out of this piece of land?
Absolutely. For us, underwriting is a very, very, very big part of our everyday work at FarmTogether, and a critical piece of any transaction. I think any real estate investor will tell you that getting the acquisition right is a very big part of the problem, or solving the problem. So
Right.
underwriting for us is incredibly important, and it depends on depending on where we're looking to acquire property and the commodity that we're in. There could be different levels of priority of which areas we're spending a little bit more time on in underwriting. But generally speaking, I think water is one area that we spend a lot of time on. We want to ensure that our properties have not only sound but superior water availability, water quality. It's something we've refined our models over time to continue to get better at helping us understand and make judgment calls on whether a property has sufficient water in our view. So that would be one very big area of underwriting for us. But obviously beyond that, it would be the underlying assumptions on the property. How productive do we think this property can be? What do we think yields could be? What do we think prices for these varietals of commodities grown on these properties would be? Looking at then real asset values, doing multiple valuation methodologies when we're looking at purchase, and understanding from a comp standpoint, what do we think the property is worth? From a discounted cash flow, net present value perspective, what do we think the property is worth? So we use different methodologies there, and also consider that at the tail end as well when we're looking to sell a property in, say, 8 or 10 years. How do we think appreciation is going to unfold? How do we think factors like inflation may impact a real property that's being held for 8 to 10 years, or maybe even longer? So there's a lot of work that goes into each of those underlying assumptions. Not to mention the fact that for FarmTogether, we spend a lot of time looking at permanent commodities, which are commodities grown on long-lived assets like trees, vines, bushes, and so these tend to be in in very specific climates. You can't readily grow these commodities in many parts of the world. And when you look at these commodities, call it, say pistachios as an example, you could have 2 pistachio orchards in very close proximity, but because of very specific factors, you could have a differentiation in potential productivity between the two. And we call those micro factors or microclimate considerations. And so the specific topography of a property can come into play. What is the grade of the property? How steep do you go from the highest point to the lowest point, and over how much distance does that elevation change? Which way do the prevailing winds hit the property, from the north, the south, east, west? And what impact might that have on the spread of pests and virology? What impact might that have on management practices, like how we put inputs down? What impact could that have on precipitation? What impact could that have on frost risk or early freeze risk, or drought? So even 2 pistachio orchards that might be across the street from each other can have very different potential outcomes, just because of the characteristics of the specific properties. And that takes a lot of attention to detail and a lot of work during the diligence period to figure out. But the microclimates play a very big role in the ultimate resilience of these properties. And it's why we often, we'll see and we'll get questions from investors on, if we're in a state of extreme drought in California, like we were just a little over a year ago, why would our properties not need water? But if you read, the most recent article and pick a big newspaper, you're seeing drought across California and farms don't have water. How could that be, right? And it's because of, one, water rights may differ from property to property, from district to district, but it also could be these microclimate issues, where a specific factor of a property, based on how it's situated, may allow it to be more resilient and not experience the same loss of yield from a water stress that another property that's growing the same exact commodity that might be just down the block is going to experience. So I know that was a lot of information, but underwriting is a very big part of our work.
Yeah, no, super interesting though. And I'm sure there are, you mentioned California, but I'm sure there's plenty of other states that, or even, counties within a state that you probably stay away from, or at least, double and triple check that everything's going to be okay. How many will cut off the water supply to farmers? Is that a big problem when a drought comes? That obviously people need drinking water, so the governments have to kind of balance. Do we supply the agriculture and so that we continue to have the crop that comes out of that? Or
yeah, I think those are difficult problems when they arise, and I think we're going to continue to see those problems come up. Right now we're dealing with more water than I think some would want in California, where the issue this year has been more flooding than drought. But
Right.
for California at least, there's over 300 different groundwater sustainability agencies, or GSAs, which are effectively districts, or you can almost think of them as like municipalities that govern how water is allocated, and even how freely water can be traded within that given district. And each GSA will form a groundwater sustainability plan, or a GSP, that's submitted to the state's Department of Water Resources for consideration and approval on how that district is going to manage their water allocations of groundwater, surface water, and the trade of water. So in our view, there's over 300 of those. There's certainly a good portion that we at this time don't have conviction in how they would allow a district to manage water, and so we wouldn't consider an acquisition in that district until we see hopefully an evolution in their groundwater sustainability plan that we think is friendlier and more conducive for agriculture.
Sure.
And then there's other GSAs or districts among the 300 that we think are fantastic, and in the top 10, top decile, and we take a bullish stance on those areas, and we try to find as many properties as we can, because we have a view that the water assets there are strong and will lead to outsized appreciation over time as a result. It certainly becomes a part of the job to make a judgment call on if you're in California, which districts or which GSAs do we think we have conviction in. If we're looking bigger picture, are there state policies that might rule an entire state out, right? And at least to this date, we have not categorically ruled out investing in any particular state over regulation of water or management of water. But certainly, this is where that thought process and that discussion would lead. And ultimately, it ends up being an exercise in risk assessment, and just understanding and making a judgment call on how we think policymakers may react, and if we think that overall a given area, a given municipality will be supportive of agriculture or not, and also if there's an abundance of natural resources that we think will sustain and allow for availability for agriculture. This only becomes an issue if there's a limit of that resource. If we are not experiencing a stressor of the availability or the abundance of the resource, we wouldn't even need to consider these types of potential conflicts, right? So I think that's another part of the consideration as well.
And so tell me a little bit about, from a geography standpoint, what areas are you investing? You mentioned California, but are we investing in any other country to be able to grow specific crops, or is it primarily the U.S. that we focus on?
For now, FarmTogether only has invested in the United States. So we're only investing in American farmland. We do actively consider and we are researching other opportunities outside of the US, but right now I would say that our primary focus remains American farmland. We do think that American farmland is superior in a lot of ways, from not just from a quality standpoint and from level of expertise of managers that we have here, but even other considerations that I think again we might take for granted, like title law in the United States, which is very clear and enforceable, and in other areas of the world that is not the case, or even our availability of different insurance products like multi-peril crop insurance, which we have an excellent crop insurance program in the United States that's not readily available in other countries. So, by and large, that's one reason we remain pretty focused on American farmland. I would say another is, and really this is part of FarmTogether's view on why this is such an exciting asset class. We are seeing a tectonic shift of ownership in American farmland, and it's just starting to take place. And we think this trend will continue for the next 1 to 2 decades. But right now, the average age of a U.S. farmer is roughly 67. So many are thinking about retirement or transfers of ownership and estate planning. And historically, a lot of these decisions were no decisions easy, but pretty clear. It would be a generational transfer where the next generation would take ownership of the farm and continue managing the property. But now what we're seeing today is the next generation often doesn't live even in close proximity to the property, or has no willingness to want to continue to operate the property, or doesn't have the know-how, didn't grow up learning how to farm, and so they don't know how to manage a farm. So we see a lot of cases now where that seemingly natural transfer is not so natural anymore, and families have this open question on, okay, we don't have a clear transfer, so we're going to look for outside of the family transfer. We're going to look to sell to maybe a neighbor, or even more often, someone we may not even know, who might be looking to expand into farming, or whatever the use case may be. That's going to represent, I think, almost 500 million acres over the next 2 decades, and we've never seen that level of transfer in the United States. U.S. farmland historically has been quite fragmented and very private. These assets have stayed within the family, often, for generations, in some cases for centuries. So we think that we're going to continue to see some really exciting new farmland opportunities pop up as a result. And we think it's important to have managers focused on the space, looking to deploy capital into the space, because if you don't have prospective farmland buyers looking at these properties, you'll have other use potential buyers. So maybe a real estate developer looking to redevelop into a multifamily complex, or industrial complex, or whatever it may be. And while we certainly understand the need for those investments as well, American farmland continues to decrease by acreage. We've lost twice the size of the state of Massachusetts over the past 15 years in the U.S., which is just hard to even conceive, but that is what data from the government has shown. And we think that we need to have continued mechanisms of finding capital to invest in this industry. So that's what we're doing at FarmTogether, and that's, again, to answer your question, why we're focused on the U.S. We're seeing all the supply start to come into the market and see the light of day, which, these are farms that may have stayed in the family for centuries. So it's super exciting to be a part of that, and to see all this great farmland available that historically hasn't been.
Yeah. What about the yield from different commodities? I'm sure there's some that are more profitable to be able to grow, and maybe there's a strong demand for certain ones. What are you seeing out there that's got a strong demand, but also yields some nice returns?
So generally, we have fluid conversations as an investment team on what varieties we continue to have conviction in. It changes from time to time. It changes what commodity markets might be, markets that we're excited about today for purchase, which markets we might think are a good market to be in if you're a seller, all those different types of considerations. But generally speaking, we still see a lot of appetite and a lot of demand supporting a lot of the big permanent commodity groups like tree nuts and tree fruit. So we're big investors in tree nuts. We've seen tree nuts find all sorts of new uses and new categories, new products being developed. I would say the biggest is probably alternative proteins. So you'll find protein powder that's now made from almonds, pistachios, hazelnuts, pecans, walnuts, probably every nut that's out there. So alternative proteins would be a big one, but even other products and new uses of tree nuts, almond cosmetic products, even durable goods. So I think we're seeing some pretty strong support for continued sustained demand across the tree nut spectrum. And we're continuing to see domestic use or American consumption, or local consumption, if we include, our neighbors, Canada, Mexico, and some other nearby trade partners. We're continuing to see demand for those commodities broadly maintain a strong position and grow. Tree fruit, we continue to see steady and strong demand consumption for citrus, apples. Wine grapes are an interesting category. We've seen some stress in the conventional wine market. So just, your conventionally grown wine grapes. We have 2 wine holdings to date, both of which are certified organic. And we've seen a different market dynamic and different market fundamentals for organically grown wine grapes, where despite there being a surplus of conventionally grown wine grapes amidst a decrease in wine consumption that we're seeing, at least for the US consumer, I think that's a trend we're seeing globally too. The demand for this, I would say, more niche and specific category among the organically grown wine grape consumer looking for organically grown grapes on their wine bottles when they're purchasing wine, we've seen that demand hold steady and even grow. So even within a commodity like wine grapes, forget about different varietals like, you have your Chardonnays and your Cabernet Sauvignons, and then, specialty varietals like Albarino and whatever. Like, even without going into varietal discussions, you can see that there might be a big trend that would lead you to have some potential hesitation or concern around investing in conventional in this case. But there's still strong market support for certified organic holdings. And this is all specific to California. The examples that I used were for California, but again, we're seeing that dynamic play out in other geographies as well. So I think broadly speaking, permanent commodities, tree nuts, citrus, tree fruit, we continue to see very steady demand across those specialty categories. Row crops, which would be your annual commodities like corn, soy, wheat, that's a market that has seen very strong appreciation over the past couple of years, particularly in the heartland and the Midwest. And then on the demand side, we're dealing with some very complex macro drivers. So obviously, the Russia-Ukraine conflict is a huge macro driver for these markets in corn, soy, and wheat. And I would say global conflict and macro conflicts are generally a driver around these markets, because these are goods that are used not just for staple food and caloric needs, but corn and soy they're used for fuel production with ethanol. They're used for durable goods. You'll find most products probably sitting around you at home are, have an element of corn or soy built into their existence. So it's a commodity group that closely tracks CPI and inflation. And again, as we continue to see the Ukraine and Russia conflict play out, of course, we're now seeing a new conflict develop in Israel. All of these different macro events can influence some of those larger, broader commodity markets like row crops. So we'll see. I think we'll continue to see strong support there for continued production, steady production, reliable production like we have in the U.S. when other production areas may not be so reliable because of other, some of these other impacts like global conflict.
Okay. One question I have, just more out of curiosity, but on my end, but as far as organic, you mentioned organic wine and grapes, and that being different than conventional. Does an organic orchard vineyard have to start as a organic vineyard, or can you, in other words, if you have been managing a vineyard for X amount of time, but maybe not doing it in the organic fashion, is there a way to change that? And if so, how does one go about doing that? If you know, I'm just curious.
Yeah, that's a great question, and definitely something that we pay attention to and something we work on. So you can certainly transition properties from conventional practices to certified organic practices. It's property dependent. So some properties may never be able to be certified organic because of characteristics specific to that property. But assuming a property could be converted to organic, it's generally at least a 3-year transition timeline.
Okay.
And it requires, a pretty meaningful change to management practices. Obviously, with organic, completely changes the ability to use different sorts of applications or inputs, like synthetic fertilizers. So it would change the management plan for a operating partner. But yeah, it's certainly possible. It's something we actually do on some of our holdings, and it takes at least 3 years, but it could take longer.
Okay. And then what about genetically modified? I mean, how prevalent is that in the industry right now? And I'd love to hear just kind of your thoughts on it as well.
Sure. We see demand for non-GMO products. We see demand for products that are created with genetically modified organisms. I think for us, I think we have both in our portfolio. We have some properties that produce non-GMO commodities and other properties that produce GMO commodities. And, ultimately, I think it comes down to specific markets and fundamentals. What are we seeing from consumers, and also what's possible from an agronomic standpoint? There are commodities out there that actually are just naturally non-GMO. So hazelnuts come to mind. There, as far as I know, there is no genetically modified hazelnut out there. Could be wrong. The last time I checked, there wasn't. So I don't think there's even a way to produce a genetically modified hazelnut. So again, these are questions that are market dependent. But in our portfolio, we have I think we have a mix of both, and oftentimes, it would come down to question them what's ultimately best for, obviously both for the property from a growing standpoint, and then also for our investors.
Okay. And tell me a little bit about the investment itself. And in as far as the hold period, and how does someone buy in to invest with you? I guess just kind of give me the overview of what that looks like.
Yeah, certainly. So we have a couple of different products available at FarmTogether. So it would really depend on what product a potential investor was considering. We have syndicated deals that we syndicate on our platform at farmtogether.com. And those are essentially closed-end vehicles. So we plan to hold those properties for a stated duration. Often, I would say 8 to 10 years is our typical hold period. And investors who invest in those deals would own a partial interest of an LLC that owns D title to a property. So, if it was a $10 million property and an investor invested $100,000 in that opportunity, they would effectively own 1% of that property, and they would be entitled to 1% of all future distributions, net proceeds from sale, depreciation. Basically that ownership interest would dictate all their future activity. Another product that we offer is an open-ended diversified fund. So we have our FarmTogether Sustainable Farmland Fund. And for investors who want to add farmland to their portfolio, but don't want to necessarily pick between different properties or hold periods, they want sort of an auto diversified pooled vehicle option. Our Sustainable Farmland Fund could be a good option. There's also additional liquidity mechanisms in this fund. So even though we underwrite to a 9-year hold, after an initial 2-year lockup period, investors can request redemptions on a quarterly basis. So it adds a little bit more flexibility on the liquidity side, which could be helpful for some investors. So that's a different product compared to the syndicated deals that are more closed end. And then finally, we also do what we call TICs, or tenancy in common structures. So these often are really helpful products for investors who may be considering a 1031 exchange and looking for like-kind alternatives to exchange into. A 1031 exchange, for anyone who may not know, is essentially a way to potentially defer capital tax liability from a sale of a real property on any capital gain that may have been generated on that property by reinvesting into a real property. And a lot of times investors may not know that like-kind is a very broad and general definition. And so if you sold a multifamily investment in Georgia, you wouldn't necessarily need to reinvest in another multifamily investment in Georgia, or even multifamily elsewhere. You could invest in maybe a apple orchard in Washington, and that would still
Right.
qualify as a like-kind exchange because you're moving proceeds from one real property investment into another. So we do those tick transactions as well, with many investors who are considering or actively working through 1031 exchanges.
Okay. Another question I have, I think of multifamily, I think of, um, various other investments where we have the management team that goes in to manage this. But in your case, it's basically going to require farmers. How do you put the management in place to know that, hey, look, if we go in on one of the syndicated deals, that you're going to have the right people in place to be able to execute the business plan?
Yeah, great question. So I would say that kind of lumps into our underwriting, and instead of sometimes underwriting properties, we're underwriting potential partners. So we have an asset management team internal here at FarmTogether, and they're responsible for managing our properties after closing. But they also work very closely in evaluating our potential operating partners and even tenant partners, and considering, from multiple perspectives of diligence on partners, from financial to also just strategic, on whether or not we think a particular operating partner would be at the caliber and level that we strive for in our partnerships, if they would be a good partner for us. So our asset management team interviews potential operating partners, and they're ultimately responsible for selecting the farm management partner that we're going to hire or lease to for a given property, and also entering into a farm management agreement or a lease agreement with that farm operating partner or tenant on how that property will be managed by that partner or tenant.
Okay. And is there a pretty wide resource of people that do just that manage that you can partner with? And I would imagine, it just seems like there's a lot of moving parts there. Obviously the work required to grow the crop, but then from there also taking it to market and being able to get the return necessary. It just seems like a lot of so having a good partner, I think, would make sense.
Yeah, super important. Their job is a big one for sure. So we certainly look at both, a couple of different factors. One, partner availability and network, right? So we might have a world class partner, but if they're the uh, only top tier partner in our view in a given area, and they get hit by the proverbial bus tomorrow, that's not a good position to be in. So we want to know that there's a network of several high caliber partners in a given area that could take over if needed. So that's certainly part of the investment thesis. And then beyond that, obviously looking at a partner's past performance, yield history, marketing ability. We do leverage our partners for marketing. So understanding which processors they work with, looking at prices that they're able to secure, comparing those prices to industry averages and other benchmarks. That's all part of the equation that goes into, ultimately deciding and selecting which partners we're going to work with.
Okay. And then, you always hear about, other countries purchasing some of our farmland and different things. And so just curious, kind of from the landscape of that business, what changes maybe have you seen? And, are there certain ways that things are trending right now in the U.S. when it comes to our agriculture?
Yeah, certainly. So, I would say we are seeing some changes here. I think every major change that I can think of has been at the state level. So states, some states have become a little bit more restrictive of who meaning like what types of entities or persons can acquire agricultural zoned land in those states. Other states have anti-corporate farming laws, and those have been in place now for many years. And then there's even been some discussion, I believe, at the federal level. I saw at least a couple of U.S. senators were considering a broader approach on this topic. Whether or not that goes anywhere, of course, is left to be seen. But that was at least the first time recently that I've seen something even being discussed at the federal level. So far, I think what we've seen, we have seen a handful of states try to be a bit more restrictive at the state level in terms of qualifications on who could be an eligible purchaser of agriculturally zoned real property in those states.
Okay. Yeah. It's super interesting. David, this has been really good. I sure appreciate you coming on and just kind of opening our eyes to some of the various things out there that people can invest in. A lot of our guests talk real estate, and while this is real estate, it's just a different animal all by itself. But would love to hear if you could share how people can find out more about you and about your company, and if they want to invest, how do they do that?
Yeah, certainly. So if anyone's interested in farmland investing, FarmTogether.com. You can sign up for our website, and you'll be linked up with all of our communications on upcoming deals, but also have access to our learning center. So if you just want to learn more about the asset class, it's a great place to start. And if anyone has any questions for me individually or on farmland as an asset class, I'm more than happy to field questions as well. And you can get a hold of me via email at david@farmtogether.com.
Okay, perfect. Well, I've got a couple other questions for you if you have just a minute. I know we're running a little long on time here, but wanted to see, if with an investor, I imagine you're an investor as well, right? Is that correct? Are you investing alongside of your investors? Yeah. So, maybe some advice that you might give somebody who's maybe just starting out with their investment career.
Yeah, I would say, whether it's in farmland or in any other asset class, I think education is critically important in understanding, can you explain? I love the 5-year-old test. Can you explain what you're investing into a 5-year-old, right? And it's actually quite difficult. And I mean that in a good way. I think you look at some new asset classes, whether it be crypto or blockchain or some of those recent asset classes that we've seen. Not many people can invest or can explain those investments to a 5-year-old and have it make sense. So I think that really demonstrates a real firm understanding. So, I would say that's my benchmark. And I think there's so much research out there and available. Again, on farmland, if you're looking for research, farmtogether.com or Learning Center. If you're looking at any other asset class, I would encourage, getting access to research and really understanding the underpinnings of how is value created in a given space and in a given investment.
Okay. That's great advice. I think, there's a book called the Richest Man in Babylon, and that's kind of an underlying theme there. If you can't understand the investment, don't do it.
Yep.
So,
absolutely.
What about a book recommendation? Anything that you've read recently that you'd like to share with the audience?
A book that I love that I would recommend. It's been a while since I've read it, but I do really enjoy it. It's called From Dirt to Soil by Gabe Brown. And it talks about, for anyone who's potentially interested in getting more of the potential carbon sequestration benefits or positive climate impacts of different farmland management practices. I've found that to be a really good comprehensive read. It does get into the science of it a little bit. So if someone, isn't a huge fan of that, it might bore a little bit at some points, but if you are a science nerd, you'll absolutely love it. And I think it really can open eyes to the potential and promise of land being a part of the solution to climate change.
Perfect. No, I appreciate that. And it's the first time somebody's recommended Dirt to Soil on the show. So appreciate it, David. Well, thank you so much for being on the show. I really appreciate you taking the time to kind of explain the agriculture business to us, and we'll call it a show. Thanks, David.
Thank you, Keith. It was a lot of fun.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.